Hey derivative traders, welcome back to another video tutorial. There are several other important areas of liquidity in the market that traders, especially those using smart money concepts, often look for. These areas represent zones where a large number of orders may be clustered, and they can provide opportunities for institutional traders to execute large trades. Understanding these areas can help traders predict potential reversals or continuations in a price movement. When the market forms equal highs or equal lows, or you see your trend lines, it is considered as major liquidity areas, often referred to as retail liquidity. Retail traders often place stop losses just above or below those equal highs or equal lows, or below a bullish trend line or a bearish trend line. Now, which makes these areas the prime targets for liquidity grabs by the institutions. Now, for an example, we have a double bottom. Now, when we see a double bottom, we understand that there is some sort of support that is supporting price, a support zone that is supporting price at a particular price level. Now, it can be two equal lows or three equal lows and so forth. As long as there is some sort of support around that area there, that particular area is prone to liquidity grabs. Now, the same is true in terms of, your double bottom, your double tops, your double tops, your triple tops, or it can be some relatively equal highs. The highs doesn't necessarily have to be equal each and every time. They can just be relatively equal to one another, and then it will still count as a form of resistance. And each and every time, whenever someone will be placing a trade, from an area of resistance, obviously they will be placing their stop losses above the resistance zone, and then such area, again, it is prone to liquidity grabs. Now we need to understand on what is happening below or above these support areas and resistance areas. Also, you need to understand that there are some breakout traders, as you recall previously, that on each and every high or low there is liquidity, and there are some breakout traders. So eventually around this area here, we'll be having those buy stops for people that will be looking to buy the break of those relatively equal highs, and they also get trapped. And then here we'll be having people that place their sell stops. Again, they will get trapped because they will be trading the breakout. Now, in terms of trend line liquidity, we have the bullish trend line, and as you know, that a lot of people will be looking at the trend line in such a way that they'd be seeing this as a potential first touch, and then this one a second touch, and then on the third touch they normally use this as a form of confirmation in order to start looking for some buying opportunities. Now, in this case, around this area here, we need to understand that there will be a lot of stop losses below these lows here. Now, most of the time, price may manipulate only the low, right, that a lot of people will be looking to place a lot of trades from around that area there, because they see that as a form of confirmation to take a trade, because they use the first touch, the second touch, and on the third touch of the trend line they want to be buying, because they see this as a potential confirmation in order for them to look for those buying opportunities. Now, sometimes, as I mentioned earlier on, that particular low may get manipulated in order to grab whatever liquidity that's resting below that low before price continues to push to the upside. And sometimes what can happen is that price can just decide to drop to grab whatever liquidity that's also below around this area here. So such areas, again, you need to be aware of of them, so that you don't get trapped on the wrong side of the market. The same is true in terms of a bearish trend line. Again, you'll be looking for your first touch, your second touch, and you'll be hoping to sell on the third touch confirmation there. There will be a lot of liquidity resting above this high. And then again, what can happen is that price can just manipulate or do a liquidity grab above that particular high before price pushes to the downside. Now, again, what can happen is that because there is liquidity, do not forget we do have liquidity above each and every high or low. So price can still, give us a slight reaction and then push to the upside to grab the liquidity that's resting above those other highs. So these are the common additional liquidity areas to look out for, with what we learned about on the previous lesson. So again, as you know, let's head to the live chart and we see how to implement these. Now, we're going to start off with the bullish trend line. As you know, that it has a lot of liquidity. So again, what will be happening here as price is pushing to the upside, creating those higher highs and higher lows. So we have a first touch around this area here. So normally a lot of traders, they would take their trend line and place it on the first touch here, on the first low, and then try to spot a second low. So we do have a second low. So on the third low here, right, they would be using that as a confirmation to do what? To look for those buying opportunities. So which means that around this low here, there is what? There is a lot of liquidity below that particular low. Now, in this case, price eventually plays out. It respects the trend line here, but at a later stage, right? So again, let's say for an example, there are some traders that were left out from around this area here. Now, what could potentially happen is that around this fourth touch here, there will be some traders that will be looking for potential buying opportunities. So that's the main reason why we have this slight reaction here. So as you can see, we do have this slight reaction to the upside, but what happens? Price significantly drops to the downside. So I'm assuming that there were some people that were looking for potential buying opportunities around this area here, and then placing their stop loss below this particular trend line. Now, you need to understand that there is a lot of liquidity. There is a lot of liquidity below these lows. And then again, do not forget, there is liquidity on every high or low. But majority of the time, the trend, right, the liquidity that will be protected will be determined by the trend. So each and every time, whenever you are in an uptrend, you want to make sure that you are buying. Why? You are buying from potential areas whereby you know that the liquidity there will be protected up until otherwise, and then they start to create a trend change. And once they create a trend change, you know that once I see a certain liquidity getting grabbed, let's say for example you were in an uptrend and you see the sell side liquidity getting grabbed, it should ring a bell in such a way that you know and understand that now price wants to target the sell side liquidity below on each and every low that got created, because previously it was protected, but now it becomes a potential target. So I just hope you understand the bullish trend line. So again, just be aware of such areas. And then another one, we have a bearish trend line. Again, what is happening here? We have a first touch, a second touch, and a third touch confirmation. So as you can see, we have a first touch around this area here, and then we have a second touch. Now on the third touch confirmation there, what happens? Price sells a bit, but what happens? It eventually pushes to the upside. And again, a lot of people that will be looking for selling opportunities around this area here becomes liquidity. And that's the main reason why price eventually pushed to the upside in order to try and grab the buy side liquidity that's resting above this bearish trend line. So I hope now you're getting the logic behind all this. And yeah, so let's look at another one, which is support and resistance. So again, we're going to come back to this example because while I was busy plotting this, I noticed something, but I just want to talk about the supply, not necessarily supply, but support and resistance. Now, as I mentioned earlier on, that the highs or the lows, they don't have to be like equal, right? They can be relatively equal. It have on such areas they have a lot of liquidity because here, as you can see, price found some resistance around this area here, and then we dropped to the downside, and then we wicked above this high here, but we found some resistance again. Price at a later stage pulled back to that very same area, found some resistance, and then we pushed to the downside again. Now, when this happens, there is a lot of liquidity that's getting formed above the resistance zone there. Why? Because people will be seeing this resistance occurring from this particular zone, and then they would be looking for some selling opportunities whenever price comes back into that particular zone. So let's say, for an example, you manage to sell around this area here. Once you see that price is finding some sort of like resistance, obviously you'd be placing your stop loss above that particular resistance. So which means that this becomes a high liquidity area for the institutions to target. And as you can see, eventually price just trades slightly above to do what? To take out each and every single person that was selling from this particular resistance. So as you can see, price trades above this this resistance that could form the. So let me just highlight that in red and then do it like this. So as you can see, price just slightly traded above those relatively equal highs. So again, what happened here? Do not forget that we do have those breakout traders. Now with breakout traders, again, they'll be looking to buy the breakout, right? Where will be they placing their stop loss? Slightly below here. So they also become the sell side liquidity now, right? So they become the sell side liquidity. So as you can see, everyone that was selling from an area of resistance, they get taken out, right? And then everyone that was buying the breakout, they also get taken out. And then now let's go to support. So as you can see here, price found some support. We gave us a reaction pullback, found some support again, pushed to the upside at a later stage, pulled back to that particular area there. As I mentioned earlier on, that the lows or the highs, they don't necessarily have to be equal. They just need to be relatively equal, right? So as you can see here, we have another reaction from that particular support. So most definitely, some people, they tend to find some confirmation when price creates the first leg, pulls back, taps into that that zone again, and then they'll be looking to do what? They'll be looking to buy either on the second leg or on the third leg, but majority of the time they get a necessary confirmation on the third leg, because once price creates the first leg, it confirms that there is support with the second leg, and then on the third leg, a lot of people will be looking for some buying opportunities there, placing their stop loss way below the low, right below the low there. And then as you can see, price eventually pulls back into that support. Now what happened here? Now those who missed an entry on the second touch of the on the third touch of the support zone, they will be now looking for what? They'll be now looking for some potential buying opportunities. So again, they will be placing their stop losses below the support zone there, which again, it creates a lot of liquidity for the institutions to potentially target. But now, do not forget that we have a support. Now, on that support, there will be some traders that will be having their sell stops below those relatively equal lows, looking to trade what? Looking to trade the breakout. So as you can see, eventually price trades below, right, to entice anyone that will be looking to sell the breakout, right? And again, as you can see, they get taken out before price significantly pushes to the downside, because as you can see, overall the trend is to the downside, right? The trend is to the downside, but there are some people that get left out before price actually pushes in the right direction, because the direction is to the downside. But again, there should be some losers each and every time. As you recall, on the previous lesson, I did mention that in order for price to push down, there should be some buyers that are willing to lose to the sellers, and in order for price to push up, there should be some sellers that are willing to lose to the buyers. And then again, as you recall, I did mention that we do have that internal and external liquidity, and each and every time, if price wants to push to the downside, there should be some other sellers that are left out, that are left behind for price to significantly push to the downside. And the same is true even when price tries to push to the upside. There will be some buyers that get manipulated or that get taken out before price significantly pushes to the right direction. Anyway, these liquidity areas are used by institutional traders to enter and exit large positions, often at the expense of retail traders who place stop orders or market entries in these areas. Understanding these zones helps traders anticipate price movements and avoid liquidity grabs. Now, that's it for today's video. If you found this guide helpful, don't forget to hit that like button, subscribe for more trading tips, and drop any questions or topics you'd like to see in the comments below. You can click here to watch my recent upload, or click the playlist to watch more content on market structure. Anyway, thanks for watching and happy trading.